Hey, welcome to Be the Boss of Your Money. I almost said money in the morning. Welcome to Be the Boss of Your Money. I'm Mitch. The show is about personal finance. It's literally about you becoming the boss of your money. It is so easy for your money to control you or lack thereof. And then you get nervous, you worry, and that just like creates like a cascading effect, like dumber and dumber financial decisions. But not all of you have that issue, but I want the show to be for everybody. I pour my heart into this and I really want you to walk away with something valuable. So I think the most valuable thing we could talk about right now after this brief introduction, it's going to be really good. Stick around and we're going to talk about interest rates, inflation, and we're going to really get into the most valuable thing I could ever tell you. That says a lot. I've been doing this for 33 years, as a financial advisor. Here we go. All right, welcome back. I'm Mitch. You probably know that by now. If you're new to the show, I'd always appreciate if you just, tap that like button, just tap it, or that heart button, or the wow reaction, or the applause, depending on which social media platform you're watching on right now. As we speak, I am simultaneously streaming to Facebook, LinkedIn, and YouTube and Twitter, all at the same exact time. And a lot of you are coming in from different platforms. So give us a like. If you have any questions, hit me up in the comments. Words of wisdom, words of encouragement. You just want to say hi, cheer me on. I would love to see that in the comments. So go ahead, do that now. I'll see them, and I definitely want to acknowledge you. And I appreciate you taking the time to watch. So what's the most important thing? Let's cut right to the lead. We talk about economic statistics and big news every day. And I could tell you that Delta kicked off the earnings season today with a great number, beat expectations, raised guidance. I could tell you two much more important numbers, though. The CPI, Consumer Price Index, came out yesterday. Inflation lower than expected. I could tell you that the PPI, Producer Price Index, we see the CPI measures what consumers pay in terms of inflation, and the PPI is for business inflation, and that came down in the 2% range. And that's a leading indicator for the CPI. We talked about that right here, that inflation would wind its way down. Inflation would plunge. We talked about that. I mean, I really did say this, and you know it. You watch the show. So inflation is coming down rapidly, and that explains why not only did the stock market recover its minor losses from last week, but it's hitting new highs again for the year. By the way, you can't invest directly into the S&P 500 or another major index. You can only invest in a security that tracks or mimics an index. So we got someone out there. Comments. Here we go. Hey, Michael Russo. Cheers, mate. Thank you very much. I really appreciate that. Kling, it's Thursday already, so it's kind of like the unofficial start to the weekend, and everybody's in a good mood Thursday night. I think people are in a better mood Thursday night than Friday night, because Friday night it's like I'm already tired, and I'm not really into going out Friday night. But Thursday night, you're still like, it's the week, and something about going out during the week is really cool. And if you come home a little tired, you're a little hungover on Friday, you could still push yourself, right? Not me, of course, but that's a different story. All right. Thank all that because Michael Russo says hello. Thank you, Michael. So what else? Oh, yeah. So we had the Consumer Price Index, the Producer Price Index this week. The PPI came out today. That was a lot lower than expected. And the employment figures were okay last week. Today, the jobless claims came out today. Oh, I'm sorry. I don't mean to interrupt you, but Michael says tonight is my Friday night. I'm taking off tomorrow. Good for you, buddy. I would have taken off. I have a golf outing tomorrow with my networking group, but I kind of put away the clubs like 4 or 5 years ago, and I don't miss it. I have the Cobra one length clubs, but I just got so into creating content. I don't have time for the golf, but I don't miss it. But I'm gonna go to the dinner, so I'll get there like 3:30, 4 o'clock, like long happy hour dinner. It's just a group of friends. It's gonna be great. There'll be like 100 of us. It's gonna be such a good time. Yeah. So keep CPI, the PPI, first time jobless claims came in lower than expected. That means fewer people filed for first time unemployment claims. And I want to introduce to you the thank you very much. Good luck people tomorrow. Thank you. And I want to introduce to you the term which you've heard before, but it bears mentioning again: Goldilocks. Not too hot, not too cold, just right. And at least for now, inflation coming down, employment still holding up pretty good. That is like nirvana for the Federal Reserve. We don't need the Fed to go into rate cutting mode. We just need the Fed to stop with the rate hiking mode. And that's good enough. I'm telling you, it's not necessarily just about low interest rates or high interest rates for the economy, for the market. It's about steady interest rates. Steady is what we want. We can make plans based on steady. We could think about the future based on steady, right? We can invest based on steady. We can be consistent. We can have low volatility based on steady rates. That's why it's so meaningful. So the most important thing, though, we focus on these economic stats and, ignore it. I'm not saying don't pay attention to it, but don't let it throw you off your plan. If the market was down, let's say the S&P was down 10% this week, which would be huge for a week. That would just be like, pandemonium. Everybody would be scared. It would be all over the TV. All right. People would go absolutely bonkers if it was down that much. And the economic statistics came out and were really scary, like super high inflation, rapidly rising unemployment. But you know what I would do? I would do nothing. I wouldn't change my financial plan. I wouldn't change my investment plan because I know why my investment plan, financial plan is set up the way it is. I'm the one who set it up. And it's to get me through my years in my 70s and 80s, maybe if I'm lucky beyond, and if I still have my mind, right? I think the housing market is still too hot, and that is also going to be a factor for the Fed. Well, you're right, Michael, because housing is like 40% of the consumer price index. So all we need is for housing to go up a little bit less quickly, and that's enough. Okay, so all we need is for housing to go up a little less quickly, and that's enough to bring down the inflation rate. And when we talk about the inflation rate not going up as much or starting to come down, it doesn't mean we're going back to prices of 2019. It just means prices have steadied where they are right now. So that's what that means. And I think that's the most important thing. Tune out the noise, and it's all noise. We will have these ups and downs. And I just think that the more educated you are about this, the more you know about this, the more we get into it, the less afraid you are, the less likely you are to make sudden knee-jerk reactions, selling everything, thinking you're going to get back in at a better time. We're buying too much of something because all you hear is crypto going up. So you start throwing your money into crypto and you look for the next crypto to buy. And then you listen to Elon Musk to buy Dogecoin at 75 cents and it goes to zero. This is not what we want to do, right? So just keep calm. Let's talk about the market real quick and then we're going to get going. First, a little humble brag. I'm just going to make this a little bigger so you can see it. Okay. I was mentioned in CNBC yesterday. I'll show you that now. Hold on. All right, here I am. There's an article yesterday in CNBC, where to invest $10,000. Here's what I wrote. T-bills. For financial advisor Mitch Goldberg, president of Client for Strategy in Melville, New York, T-bills are the place to be if you want to earn the best, safest income. Nothing that is safe pays a good yield, and nothing that pays a good yield is safe, except for T-bills at this time. Goldberg suggests laddering 3-month, 6-month, 9-month, as well as 1-year treasuries. All are yielding over 5%. If the short-term T-bill yields decline, you'll be glad about owning some 1-year bills. If rates move even higher, you'll be glad you only have to wait 3 months for the shortest maturity to mature, so you can reinvest for a higher yield to roll it over into a new 3-month T-bill. There is also a bonus for those living in high-tax states. The interest earned on treasuries is free from state and local taxes, he pointed out. So it's quoted there. Thank you very much, CNBC, for including me in the article. And that was really cool. Oh my God, Rita's out there. Hey, Rita, I miss you. I hope you're well. I've been meaning to call you, or you a call. How's it going over there in your new digs? Man, oh man, we talk about you still, and we miss you. We miss you anyway. Thank you, Rita, so much. All right, so a couple of other things. So let's talk about interest rates. So inflation comes down, interest rates come down, mortgage rates are coming down a little bit. All right. But if you see all this red on the screen, well, they just turn a little positive. But basically, short-term yields have not gone up as much. Longer-term yields, the 10-year was over 4%. Now it's back down to 3.76%. The case for owning longer-dated bonds is actually getting pretty strong. Let me get rid of that scroll up there. All right. And let's just take a look at some watch list stuff. The 30-year mortgage is back down to the high 6% from the 7%. So that's encouraging. The VIX hasn't moved yet. And I know people say, like, what the hell is the VIX? I wish I had a better way to explain the VIX. All I can tell you is the VIX is an index that we use to gauge volatility. When the VIX goes up, it means nervousness has crept into the market, and the market starts to get volatile, maybe goes down. When the VIX is low, it means investors are feeling very confident about the market. If the VIX stays low for a long time, it could mean, though, that investors are a little too overconfident, maybe a little too complacent, and then we need something to shake them out of their stupor. All right, so that's about it. Rates came down. CPI, PPI came down. Inflation is coming down pretty quickly. Now the worry is, well, inflation is coming down now because we're going against easier numbers a year ago. But as those numbers roll off, how's inflation going to look in a year compared to today's numbers? Like I said, there's always something to worry about. There's always another statistic around the corner. But if you have your investments and your financial plan all set up, you don't have to be making changes for all this stuff. I like to talk about this stuff. I think it's interesting. And I think if you're more educated about it, you'll be more likely to stick with a plan. And the way a plan works is by sticking to it over the long term. I mean, what good is a plan if you can't stick with it, right? Thanks so much for watching. Have a great day. I don't do these streams on Fridays, so I'll be back to you Monday. And, awesome. Hey, Michael, thank you very much for that compliment. Great explanation. I don't usually get that when I talk about the VIX. So thank you very much. Have a great day, and I will speak to you guys on Monday. By the way, you can check me out. If you want to reach out to me and take our conversation to a one-on-one, you want to sign up as a client for investing and financial planning, reach out to me, send me a DM. We'll talk. I think maybe a 10 or 15-minute conversation with me is probably worth your time. We can always do that. Speak to you soon. Thanks so much.